When we came into the first quarter, the expectation was very high that the Fed would continue to cut rates. However, with the Iran conflict driving up prices, it is now not likely that the Fed will cut rates. In fact, it's even raising the possibility that they might raise rates. Good morning, and welcome to Life in the Markets. My name is Stephen Rohr, and I'm a wealth manager here at the Life Financial Group. I hope you had a wonderful weekend, enjoying the warmer weather that we've been experiencing, at least here in Pennsylvania. Last week, the U.S. stocks ended a bit lower. Not much, but a bit. This was actually their weakest session since March, as oil and also treasury yields climbed because of inflation worries as data has come out, and also as the Fed leadership changes. However, the S&P 500 still ended up ever so slightly. It ended up 0.13%, as opposed to the NASDAQ, which was down negative 0.38%. So again, generally very small movements. The Russell 2000 was down a bit more, negative 2.69%. The international was down about the same. Gold and silver were both down about 3% and 5% respectively. However, oil climbed. That is the one we would not like to climb. And it rose about 6.8%. And it's back over $100 a barrel. Year to date, however, most of the indices are showing a healthy return. So the S&P 500 is up 8.22% year to date. The NASDAQ is up a whopping 20%. The Russell 2000 is up 12%. And that is the more smaller companies and mid-cap companies. So that is a good indication of growth there away from the big names. The bond market was also down. When the bond market is down, it usually means that the 10-year Treasury is up. And that is what we saw this week. Bonds, the AGG, the AG, was down negative 1.17%, and that was fairly indicative of the bond market. Now, the 10-year Treasury was up 5%, a fairly significant jump. So that puts it at over a 10% increase year to date. This really is reflecting the increasing expectation that the Fed is not going to cut rates again this year. When we came into the first quarter, the expectation was very high that the Fed would continue to cut rates. However, with the Iran conflict driving up prices, it is now not likely that the Fed will cut rates. In fact, it's even raising the possibility that they might raise rates. Oil prices, as I mentioned, are the main driver of this scenario here, because of the Iran conflict. Of course, as we've been saying, the longer that it hovers over $100 a barrel or around $100 a barrel, the greater the downstream impact it's going to have on the economy. And we are starting to see this as the latest Consumer Price Index report shows. This is for April. The cost of all goods, including food and fuel, are up 3.8% year over year. So from last April to this April, they're up 3.8%. Now, the cost of all goods without food and fuel was up 2.8% year over year. So up, but not up nearly as much as when you include the food and fuel. Now, that is what we would expect. However, the price increase for last month for goods, so excluding the food and fuel, it went up 0.6% in April. However, the price of goods, including the food and fuel, only went up 0.4%. So what does that mean? That means that, like we've been saying, the lagging effect is starting to show. So the price of goods excluding the oil and food, that went up slightly more than the price including the oil and food. So the lagging effect is starting to tell there. We will see how that begins to play out. And hopefully, if the Iran conflict is able to be concluded, we will see that start to slow down. Now, despite the high effect of oil prices, the 12-month increase in cost was the same in April 2025 as it was in April 2026. So, for instance, the year over year from April 2024 to April 2025, that increase was 2.8%. The year over year from April 2025 to April 2026 was 2.8%. So we aren't seeing a dramatic spike or anything like the 6.2% that we saw in April 2022. However, 2.8% is still higher than the Fed would like, and obviously a lot higher than we consumers would like. Some of the negative effects of this increased consumer price index number is that mortgage rates are unlikely to go down. And this is because the Fed is unlikely to cut its rates. Now, this is really unfortunate because the mortgage interest rates were finally dropping. They'd hit a 3-year low in February of this year, right before the Iran conflict began. But now they're climbing up again. The high mortgage rate are really making it difficult for young homeowners or would-be homeowners to get into their first home. Now, while we aren't seeing the high double-digit interest rates that many of you saw in the 80s, the price of homes adjusted against the wages that people are earning is dramatically higher than it was in the 80s. The interest rates may not be as high as they have been, but the high interest rates comparatively that we're seeing today, combined with the dramatic growth of home prices and the comparative not growth of the wages, is really pricing a lot of people out of getting their first home. In a conversation with clients this week, a client brought up how in his industry, he was beginning to see a number of jobs created to be AI specialists in that industry, to be able to use it well, to train it well, and to apply it in their context. This was an excellent reminder of how technology has affected the world throughout history. When a revolutionary technology appears, there are at least two emotions that often appear as well: fear and greed. You've probably heard us talk about those before. Those often show up in investing. They come up in other contexts as well. In this context, with new technology, fear comes up because it means jobs were likely going away. Greed comes up for the money and efficiencies to be gained with the new technology. Put less negatively, however, many feel at least apprehension for the disruption of the status quo, or they feel excitement over the opportunity that the new technology offers. During the industrial revolutions of the 1700s and the 1800s, inventions like the spinning jenny, which transformed the weaving of clothes, or the steam engine, various iterations of the steam engine, which enabled countless other manufacturing inventions, or the tractor, which obviously reduced the need for agrarian labor. These inventions eliminated hundreds of thousands of jobs over the course of those decades. However, they created even more. Those machines then needed operators, trained mechanics, people to make the machines themselves, and factories needed construction companies to build them, and then they needed managers to run them. The same thing happened throughout the 20th century as new technologies continued to be invented. The internet and computers, or most famous and most recent disruption, transformed the world. But while the internet and computers removed the need for many jobs or even industries, you can look at the phone book industry, for example, it has created countless more jobs and industries. Just because a new invention is new, it often feels like we are wandering into the abyss of the unknown. And there are absolutely unknowns when a new technology comes onto the scene. But as Solomon pointed out in Ecclesiastes, there is nothing new under the sun. Patterns repeat, even though they aren't the same exactly. We can be encouraged from history that God made humans. He made us to take dominion. He made us to be creative and to invent and innovate. And he has given the earth to us to manage and have dominion over. And as his image bearers, that role is not going away. It may look different as new efficiencies are gained and as we are able to do things in a different way or do things that we weren't able to do before, like fly. But God still is using us and has empowered us with the authority and the job of managing and filling and having dominion over and beautifying the earth. So as we go into this week, be encouraged. Look for the opportunities that come with the new technology. Verse for this week, Malachi 3:6. For I, the Lord, do not change. Therefore you, O children of Jacob, are not consumed. Now, a reminder, there will be no video next week. Happy Memorial Day weekend. Enjoy time with family and friends as we reflect and remember those who have sacrificed and died on our behalf to maintain our freedoms and the liberties that we enjoy. Thanks for joining us. We hope you will like and share with those who will benefit from the materials and resources that we have provided here. We'll see you in 2 weeks.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.